Financial services, consumer protection, and mobility over the next 5 years. Financial services, and in particular, availability of credit, has supported economic opportunity for families for decades. Policies to support home ownership played a key role in building the middle class, as the nation's home ownership rate increased from 44% in 1940 to 62% in 1960. Yet despite this accomplishment, these efforts were incomplete. We now recognize that many of these policies excluded communities of color from the same economic gains, contributing to a racial wealth gap that persists today. And in the wake of the Great Recession, with over 5 million families having lost their homes to foreclosure, many Americans are clearly wondering about the future of the financial system and what it means for them, both in terms of just getting by from day to day and year to year, and really, more importantly, getting ahead. Polling reflects this anxiety. In 1979, when Gallup surveyed Americans about their level of confidence in banks, 60% of respondents said that they had a great deal or quite a lot of confidence. In 2014, this had dipped to only 26%. Clearly, there is a lot of work that needs to be done to rebuild that trust. At the Center for American Progress, we are committed to pursuing progressive ideas that expand the middle class, and we recognize the role of safe and affordable financial products that help families achieve their goals. Last year, we released Lending for Success, a report on the types of lending practices that are beneficial to families and communities, and the types of deceptive and predatory practices that cause them to fall behind. And we have worked hard to develop proposals that would lead us toward a financial system that works for everyone. This year, we will continue to make that case for policies that support responsible lending practices and expand financial inclusion. We will also examine ways to ensure that financial products account for the growing diversity of our country and harness new technology in ways that expand opportunity in the financial marketplace rather than opening new doors to consumer harm. We have 2 panels today. The first will discuss financial services and mobility before and after the financial crisis, and the second will address key issues for policymakers and regulators to consider over the next 5 years to ensure that consumer protections and inclusive finance will lead to greater opportunity and mobility. I'd like to briefly introduce the 3 panelists who will be on our first panel. Mike Calhoun is the president of the Center for Responsible Lending, which is the policy affiliate of Self-Help, the nation's largest community development lender. He has spent more than 3 decades on the front lines of economic justice, including 10 years as a legal aid attorney, and formerly chaired the Federal Reserve's Consumer Advisory Committee. Jim Carr is a visiting fellow at the Roosevelt Institute and the Coleman A. Young Endowed Chair and Professor in Urban Affairs at Wayne State University. He previously served as Senior Fellow here at CAP, as Chief Business Officer for the National Community Reinvestment Coalition, and as a Senior Vice President at the Fannie Mae Foundation, among other positions. And lastly, our moderator, Michael Barr. Michael is a non-resident Senior Fellow at the Center for American Progress and the Roy F. and Jean Humphrey Proffitt Professor of Law at the University of Michigan Law School, as well as Professor of Public Policy at the university's Gerald R. Ford School of Public Policy and a Senior Fellow at the Brookings Institution. He previously served as the Assistant Secretary for Financial Institutions at the U.S. Department of Treasury in 2009 and 2010, and in several policy roles in the Clinton administration. Thank you for joining us today, and enjoy the conversation.
Thanks very much, and thanks to all of you for being here. I'm going to say just a few words of opening remarks, and then open it up for a conversation with my wonderful, distinguished panelists and friends here on the panel. I want to say at the outset that I think most of us want a financial system that is safe and that is fair and that is harnessed to the needs of the real economy, that helps the economy grow in a way that brings everybody along. And I think that's a critical role for finance to play. It's a role we need for finance to play. And I think that, unfortunately, the financial system has fallen down on that job in 5 ways I want to briefly describe. The first way is that finance has tended to reinforce inequality because in the past the financial system was able to take risks that benefited the stakeholders of very large financial institutions. And when those risks blew up and destroyed the economy, everybody in the economy suffered. And people at the bottom of the economy suffered the most. The second big way that I think finance has fallen down on the job in the past is that there has been too many instances, of which Jim and Mike, I'm sure, will speak in a moment, of abuses, of predatory practices, of taking advantage of minority and women borrowers. And those predatory and abusive practices have stripped wealth from the people least able to afford it. The third way that the financial system, I think, has fallen down on the job is not generating in a positive way enough of the kinds of products and services that could actually help low and moderate income people get ahead, have low-cost ways of receiving their income, of storing it, of paying their bills, and of saving and building an emergency cushion so that small problems don't lead to big ones over time. And that third area, I think Jim is now spending a lot of time in Detroit. I've spent a lot of time researching in Detroit, is a critical issue. And I wrote a book a couple years ago called No Slack, The Financial Lives of Low-Income Americans, that based on that lived experience of families in the Detroit metropolitan area. A fourth big area of concern, we want our financial system to help small businesses and entrepreneurs get ahead and be able to be successful. Minority and women-owned businesses still in today's world have a much harder time getting access to the capital they need to grow. And that reinforces the wealth gap in our country in significant ways. And lastly, we have a basic problem of the intersection of finance and money and politics in our society. And the financial sector still has too much influence over the policies that get enacted in the Congress. They retard the ability to make progress in key areas. And I think we need to tackle all 5 of these areas if we're going to make progress ultimately on making a system that's safe and fair and harnessed to the needs of the real economy. So with that overall frame, let me just open it up, and maybe Jim will start with you. How do you see this issue of finance interacting with the broader themes of economic justice that you've been working on for your career?
So thank you, Michael, for the question. You know, the reality of it is that without access to low-cost, safe, sustainable financial products and services, economic mobility is simply not possible. I think it's even more important to understand, however, that even just sustainability, just financial security without talking about mobility is also not really possible. And one of the things when we talk about financial services, we often think about maybe homeownership first, for good reason. It's the largest source of wealth for the typical American household. And then we talk a lot about things like small consumer loans, like payday lending. Those are the 2 big ones. But it's really important to understand that our financial system really, in order to be fair and provide real justice to people, must make sure that they have access to low-cost check cashing, a way to save their money safely, and if possible, every penny that they're saving, get some type of return on it. A way to take out, as you said, Michael, a small business loan if you're an entrepreneur, to take out a safe car loan. In fact, payday lending and car loans, I know it's a big part of your work, Michael, and Center for Responsible Lending. But it's a continuum that goes all the way through to safe and secure insurance products, right? And if you take any one of those out, it's hard to see how you have equilibrium or stability. So just take insurance, for example. You can have the best savings plan on the planet Earth, But if you don't have the appropriate car insurance or automobile insurance or homeowners insurance, one serious event can just wipe you out. So I think economic justice, the new challenge in social justice is economic justice. It has been missing historically in America. We're hearing a lot of talk now by a lot of the presidential candidates about really getting into these issues of historic denial of access. And I think that is a really important part of our social justice agenda.
Mike, I want to talk a little bit with you about how to get the voice of everyday citizens more engaged in this process. You know, I think back to 2007, Martin Eakes was one of the first people saying to people, these predatory practices aren't just going to hurt low-income families, they're going to get 20% default rates and blow up the financial system. And nobody would listen to him back in 2007. You have this doctor in Flint. Families went to the doctor in Flint and said, our water is poisoned, and nobody would listen to her. You all are at the forefront of trying to get the system to listen to the voices of people on the ground. So what problems are you seeing that you think need to be brought to the public's attention, and how do you get more action from leadership in responding to voices of citizens involved in this?
Well, I think a big challenge, as you said, is the power of the financial services industry. And we've basically gone through this grand experiment. If you roll back to 1970s, pretty much all financial transactions had significant safeguards at a state basis and some at the federal basis. So for example, mortgage loans, a typical provision, most states had a limit of you could charge 1 point in fees because they realized there was a consensus that piling a bunch of fees on would strip equity. Around 1980, we passed major deregulation that deregulated all those fees and said you could charge unlimited fees, unlimited interest, and we sort of did that across the board on consumer products. And then over the next decades, what were products that had the potential to help people build wealth? I mean, I think the starting point here is due to slavery and discrimination, we start with a heavily tilted playing field. And then as what has happened over the last 20 years, we have made those with low wealth more vulnerable, more subject to predatory practices. And I think what we're now seeing with the Consumer Protection Bureau, and I know the second panel will talk even more about this, is the markets don't work without basic rules of fairness. So two comments, and then I know we got other areas to cover on the subprime crisis. First of all, the subprime crisis was hammering low and moderate income families and families of color way before the financial crisis. So our research showed if you took out a subprime loan, mortgage loan, in 2000, you had a 1 in 4 chance that would end up with you losing your home. And remember, since 90% of people were already homeowners before they got a subprime loan, subprime lending was a huge net drain on home ownership. So for example, home ownership in families of color peaked in 2004. And then from a political standpoint, I remember in 2007 at a hearing, I think you may have been testifying there too, one of the members of Congress said in the hearing without a sense of irony at all that this isn't just about the subprime market now, this is really a problem now. And it wasn't until it had that broader impact. But then the flip side is we as a lender. So at the same time of subprime crisis, we were making loans. Our loans are average borrow income $30,000, down payment of 3%. And they performed well even through the crisis, less than a 4% default rate. All 30-year fixed rate mortgages fully documented with escrow. But we were competing against people who were offering loans with teaser rates that exploded. 3/4 of the subprime loans in the crisis had no escrow. And so they looked like they were $300 or $400 a month cheaper to the borrower, even though they only would work as long as you had an highly appreciating housing market. So it's both bad for consumers and without a basic set of rules. You see this, for example, with overdraft today. Banks compete with free checking paid by overdraft fees imposed largely on low and moderate income households. But if they stop charging those overdraft fees, they can't compete with the ads for free checking.
$32 billion a year in fees. That's a healthy hunk of change.
Yes, our insured depositories subsidizing upper income account holders with onerous fees on low income households.
And Michael, can I just
John,
add
yeah,
to that?
please.
Because I think Michael makes a really important point, and I just want to drill down on that one point, which is it's not just that people of color have historically been excluded from accessing low-cost financial services. It's not like, okay, well, so you don't get the best deal, you get a slightly worse deal, meaning a little bit more expensive. It tends to go from first class to absolute predator. And so, for example, during the early years of FHA and the VA loan programs, in which African Americans and Latinos should have been had access to on an equal level, including the VA, having served in the war, been a veteran, but still not able to access those programs. The alternative was for African Americans to buy homes on, in many cities on a rent-to-own basis, similar to the way you'd buy a toaster oven. So that you paid a down payment, you paid a monthly payment, you accrued no equity, and if you had a single default, the house could be taken, all the money taken from you, you could be ejected, and a new owner brought in to start that process over. And more recently, it was either 30-year fixed rate conventional mortgages, or it was loans that in many cases were designed to trigger unaffordable payments, which is another way of saying designed to fail. And so I think it's really important for people to understand the racial wealth gap, which is huge. It's not just because of a lack of the best financial services. It's a lack of financial access to the best, and in place of it, services that actually strip the wealth. So it actually diminished your wealth rather than costing slightly more.
Jim, how much, just to pick up on this, how much of this, this is obviously a big part of the story of the racial wealth gap in the United States is around home ownership for African American communities as compared to white communities. I remember a few years ago, Raphael Bostic wrote a paper showing what happened to the typical house that an African American homeowner bought compared to a typical house that a white homeowner might have bought, and the home prices declined significantly more for African American households.
Right.
So how much of this should we think of as being about the racial wealth gap as being about home ownership, and what other factors do you think are important in the mix?
Sure, because African Americans, Latinos tend to be lower income, a disproportionate share of their wealth is in the family home. And the racial wealth gap is pretty substantial. It's 15 to 1 non-Hispanic whites to blacks, and about 12 to 1 for non-Hispanic whites and Latinos. But an interesting study that was just released not too long ago, last year, by Demos, showed that you could close the racial wealth gap by a full 30% by just equalizing home ownership rates across race ethnicity. That is a powerful finding, because a lot of people, when you hear these huge wealth gaps, you think, oh my God, you know, education, raise labor, wages, and on and on and on. Yes, all those things are important, but just equalizing home ownership could have a substantial impact. And to your point, Michael, African Americans don't enjoy the same returns to the homes they buy because of discrimination in the markets. Demos also estimated, as I recall, between 8 to 10 percentage points more of closing the racial wealth gap if we could purge discrimination in a manner that would allow blacks and Latinos to enjoy the same rate of return on the housing they buy. So we're talking almost 40% of the racial wealth gap being closed by home ownership. And I believe that that's one of the reasons why we really have to focus on that policy as sort of the most important with respect to wealth. But at the same time, not lose sight of the fact that those auto loans and payday lending and all the rest can stifle your ability to even become a homeowner for people whose incomes would say they should be, but if they can't get small consumer loans, then they lose the whole opportunity for real wealth generation.
Let me then switch then to Mike and say, you know, the CFPB is coming out with a rule at some point this year on payday lending. What kinds of problems are you seeing on the ground related to small dollar lending and abuses in that market that you hope the CFPB would address in this process?
So it is, there are rumors that they're going to come out with a rule in our lifetime.
I have no idea. But
They are going to come out with something this spring. And I think following up on both of these, there was a phrase popular certainly for a while that talked about these services as being a poverty tax. And I think is what people are seeing now is it's much more than that. And when we look at which issues we're going to focus on, we look at which ones have the most profound impact on people's long-term prospects. And a lot of these do this. So just for example, this rule that the CFPB will cover covers car title loans, a form of payday loans or payday loans on steroids where instead of giving them your pre-signed check, post-dated check, you give them your car title for a balloon loan, and they will advertise no credit check required. They will provide a loan where the payment can even be more than your income because they lend. You have to own the car out free and clear, and the usual standard is they'll lend half of the wholesale value. 20% of those people end up going from a owned car, free and clear, to losing the car for this transaction and paying 200 to 350% interest in the interim in addition. That's far more than just paid some extra interest. You see that across the board. For us, maybe the most profound place right now is in the private student loan market, where if you look at the 4-year programs are almost all 100% online. About 98% of the programs are 100% online. If you look at African American students, for example, after 6 years, those students, only 20% of them are either still in school or have a degree. 80% of them are not in school, don't have a degree. On average, owe more than $20,000 of non-dischargeable lifetime debt. And if they're in default on that, that also disqualifies them from additional student lending to move into a productive program. And so rather than, here's somebody trying to do the right thing, play by the rules, take a step up, and they have got a serious financial weight around them for the rest of their lives. And you see that across the board. So payday, to have a payday loan, you have to have a checking account. You are banked if you get a payday loan. Well, again, about 20% of those people end up crashing and burning, even though they have a live check that they can deposit repeatedly, which they do.
They do.
For $35 a pop for their fee, plus another $35 from the bank. And that is the leading driver of pushing people out of the banking system, having their accounts closed. So again, it's not just that they paid 400% interest for better part of a year to borrow a few $100. They get driven into the fringe, deeper into the fringe financial services where now they're using a check casher. They usually are disqualified from getting a new banking account. And there are all these places, and the CFPB is doing a pretty good job of targeting those. But these really change the financial direction of people's lives. They go from modest stability or even trying to move up to long-term financial marginalization, which just has a huge impact. And debt collection's another place where they robo-sign again these claims against people, often for debts they don't own, get judgments. They'll come in and get a couple hundred of them at a time in a court hearing. In most states, those judgments are on the books for 10 years. Destroy your credit record. They'll collect on maybe 2% of them. That's sort of the economics of the business.
Your life.
But they've destroyed another 98 families for the 2 that they collect on for the next decade.
So let me ask one last question for the panel, and then we're going to open it up to all of you for questions. So oftentimes people talk about striking the right balance between access on the one hand and protection on the other. I at least always find that conversation funny because You don't want to give people access to a horrible product that blows up and hurts them. And you do want to give them access to a good product that helps them. But the debate is often framed this way. I remember when we were working on the Credit Card Act of 2009, people said, if you put in place these credit card protections, nobody will get access to credit cards and their interest rates are going to go through the roof. And the latest study I've seen in the academic literature says $11.9 billion every year are saved by consumers under the Card Act. No higher interest rates, no reduction in access. So how's that for a softball? Do you agree?
Well, and I think you saw this initial transition period where and it was hard to tease out because you also had the Great Recession, where there was concern about reduction in subprime credit card offers. But now those are back up to pre-crisis levels of offering those, and they're much more transparent. And I think most credit card companies, credit card profitability is back to historic levels. I think most in the industry would agree, for example, with credit cards and with the mortgage market, that we have better functioning markets. An area that needs particular, I think, care with, and the CFPB is doing a reasonable job, but it needs to monitor, is documentation of alternative income. You don't want phantom income, but you have to recognize, particularly, for example, in the Latino community, that you have more people on a cash economy or multiple sources of income. And so you have to have ways, and the CFPB, even with the payday rule, is looking for ways to make sure that that's accommodated. But I think that's a important concern.
Sure, just real quickly, Michael, it's a really good question, and one of the things that challenge for people who are sort of representing people of color and trying to get better financial access is the disingenuous conversation that says, well, if we allow more access, we have to loosen our underwriting criteria. I mean, we have to loosen our credit standards. We have to assume more risk, and all these sort of things that is completely ridiculous. It almost sounds like you can either have no access or exploitative access, but there's no way the system is going to create that middle ground. And I think that that is one of the biggest pieces from our sort of financial services provision, which is the CFPB is really mission to prohibit really bad lending. It is not in a position to really promote and make available access to different types of loans. And but what's interesting about it is that historically, going back to the 1930s, when the vast majority of non-Hispanic white households were working class households, we had that access, right? So everyone knows the story of It's a Wonderful Life and Jimmy Stewart and building and loans and savings institutions. People put small dollar amounts in. They actually had a rate of return, and that system worked. That system doesn't work today. If you're putting those small amounts of dollars in many banks, you're actually paying them for the privilege of holding your money, which of course they lend and invest in other ways. And then the other thing I wanted to say real quickly, when you were talking, I just remember a commercial I heard not too long ago that said, your money is funny, your credit is whack, and you can even have recently defaulted on a car loan, but we guarantee you, you can buy a car here. And so, you know, it's kind of like, if your money is funny and your credit is whack, you don't deserve a loan. And you need to clean up your credit act, you know, your whole financial act. And if you can do that, then you should have access to a low-cost, safe products. And so it's almost as if people are suggesting that, well, anybody should get credit, and no one's suggesting that. We're simply saying that the system should operate in a way in which just because you're a lower income doesn't mean that you are no income. And just because you have a lower credit score doesn't mean you are not credit worthy. We need a system, we need systems in place that do on the proactive side what CFPB is doing sort of on preventing abuses, that actually can create something like, you know, products through the U.S. Postal Service, or even a new set of financial institutions that have, you know, sort of privileged borrowing rates so that they can really offer low-cost, affordable financial services and products. But you're right, everyone doesn't deserve access to credit, but everyone deserves at least an understanding of how they can better improve themselves so that that access is available, and then the systems need to be there for them to access when they're ready.
Great. Let me turn now to the audience. We have a mic that will travel around. And there was a question here on the right.
Sharon Bovat, voice of a moderate. I would really like to take the racial element out of it, because being a woman who went through a divorce that couldn't get a loan for property that I got, so I just had to, luckily I could pay it off. But when I look at the people of Iowa, when I did some research there, they actually voted for Obama because they wanted change, they wanted fairness. They knew something was happening. If you saw the movie The Big Short, which should be required for every member of Congress. But what the question is that when you look at this predatory lending, and that it still happens, and the first African-American president who had an attorney general that was also, they did not jail any of those bankers. And I just see a lot of frustration with the Republicans, the Democrats, the independents, and I believe that's why we're having a revolution today political with Bernie Sanders and also Trump. So my question for you is there a rapid way to solve this problem? Also, the banks got a clean slate. Why can't we have legislation that people get a clean slate? Thank you.
So maybe we'll each try and do like a couple seconds in response to a big range of issues that I think you appropriately raised. I'd say the first thing is I wouldn't take race out of it. I would add gender into it, because there's enormous, I think, still discrimination in our financial markets that affect communities of color more than others. And as I said in my opening remarks, there are many instances in which women are disadvantaged vis-a-vis men. And of course, if you're an African-American woman, you're really in a lot of trouble in that marketplace. So I guess I'll take that little piece of it as mine.
So I would say Obama got the rhetoric totally wrong and the timing totally wrong, but did a pretty good job on the substance of financial reform. And you're seeing that in the details of what's going on in the market at both ends. On the rhetoric and timing, the banks had just crashed the economy, and he thought that he reassured everyone to get the financial system back in order. But people were mad, and they should have been, and he did not direct that anger towards the banks. He also took on financial reform, almost a full year and a half into the administration, and I think people wanted that to be the first thing he did after the Stimulus Act. So on timing and rhetoric, a lot of us think he got it wrong on that. On the substance, though, you are seeing, everyone agrees, most people agree the banking system is much safer. The level of capital, the big banks are selling off enterprises. They're being taxed with higher capital standards and higher fees if they get too big. You just saw, for example, GE Finance totally get out of the banking sector because these capital requirements and taxes were too big. They're just not going to do that anymore. The Consumer Financial Protection Bureau is one of the great success stories of the work of this administration. Everybody's got busy lives. It's hard for that kind of detail to get through the noise of every day. But on the substance, yeah, there's some things, panel will talk about, should you reinstate Glass-Steagall and things like that. But it was profound reform that actually got through, and that's why, I can remember the bankers were cursing this guy. They were like, we talked to him, and and we say we want these things. He says, well, are you going to support, and he would ask them, are you going to support this bill if we fix these things that you're concerned about? And they'd say no, and he'd say, why in the heck should we change this and weaken the bill? And they didn't, and they passed it over just about the bank's dead bodies, and people who weren't here for the fight don't realize how much the banks hated Dodd-Frank and how much the payday lenders have spent fighting Dodd-Frank, and today are fighting, throwing everything at the Consumer Protection Bureau, including television ads during the Republican first debate to attack the CFPB, because it is fundamentally changing those markets.
Yeah, and I just add really quickly, I strongly support and identify with both of the sets of comments, but to yours about the progress of the Obama administration, I'd say that you're not alone. Lots of people are frustrated that, executives who actually helped to create the crisis, many of them were able to keep all their wealth. No executives of any of the major firms went to prison, and I think a lot of people are frustrated with that. But I think we have to recognize that in order to have these monumental and fundamental changes really take place, it takes the American public demanding it. And when Obama was elected, I think that was really the beginning of a groundswell, and I don't think it's over. And so I think this time around, whoever's the next president, they're going to, the public, like you, me, and everyone on this panel, is now demanding it louder than ever. And I think you can see it now. Just look on both sides of the political spectrum. The Democrats are now arguing with each other of who's most progressive. To me, that's like fundamental. We've gone from boasting about being moderate Democrats to being progressive. Well, we have to be progressive. But if you look on the Republican side as well, you have a candidate who is absolutely not a politician per se, and who's leading, and no one can explain it. I think you can explain it by they're not part of what's considered to be the establishment. So I think the public on both sides actually wants real change. And I think that rather than get frustrated that this administration that had to start off its work digging out of the hole called the Great Recession, which was the worst recession since the Great Depression, they made a lot of progress. Just putting together CFPB alone was an enormous lift. And so we should be happy that we got that, celebrate it, and now look toward the next president to really take us to the next several levels up until we get to where we really need to be as a country.
So I think Jim and Mike and I could probably spend the next couple hours up here, but we have another panel that I think, I can do one more? I've got this signal I can do one more. Yeah, I think that, sir, with the glasses, you were the next up. Could you pull it
I wondered if you could address the connection between health, if you will, events and the access to the financial system in particular, whether Obamacare may do something about improving the financial welfare of more vulnerable Americans?
It's a great question, and there's actually some nice, quite interesting new research on this question showing that the expansion of healthcare coverage to low and moderate income households helped to increase their financial stability and reduced various ways of measuring financial distress. So I think having health insurance is an important part of being financially stable, and I think you're exactly right.
So just, in the mortgage field, well, two things. Elizabeth Warren, got her start studying the bankruptcy code and what was driving bankruptcy, and she found that health expenses, uninsured health expenses, were one of the biggest drivers, despite people's preconceptions otherwise. In the mortgage area, medical bills were one of the major disqualifiers for moderate income home owners to get a loan because they tend to be very aggressive. And so one of the early things we did, we started self-help in art lending in 1981, was we started not counting that against people if they were paying their other debts, that it didn't reflect their lack of character and willingness to repay. It reflected lousy health insurance, getting sick, and very, very aggressive bill collection reporting on your credit report from the medical collectors. And eventually, Fannie and Freddie, we worked with them, and they took the same step and documented that the home loans performed well, notwithstanding disregarding the medical debts when looking at somebody's eligibility.
So please join me in thanking Jim and Mike, and thanks to all of you.
Thanks, Michael. Good afternoon. My name is Joe Valenti. I'm the Director of Consumer Finance here at the Center for American Progress. And while our events team is having a little set change, pay no attention to the folks on stage, I'd like to tell you a little bit about our next panel, which I'll be moderating. Today's panel brings a broad perspective to consider the steps policymakers and regulators should be thinking about, with backgrounds in advocacy, journalism, civil rights, financial inclusion, and venture capital. Lisa Donner is the Executive Director of Americans for Financial Reform, or AFR, a coalition that brings together more than 200 national, state, and local groups to work together to reform the financial industry. Prior to joining AFR, first as Deputy Director, Lisa was the Executive Director of the Half in 10 campaign and the co-director of the Center for Working Families. Helene Olin is a financial journalist currently writing for Slate and Inc., and has written on politics, economics, workplace culture, and women's issues for a wide range of publications. She's the author of Pound Foolish, Exposing the Dark Side of the Personal Finance Industry, and also recently released The Index Card, Why Personal Finance Doesn't Have to Be So Complicated, which she co-wrote with Harold Pollack. She's also, to my knowledge, the only panelist here today who has appeared on The Daily Show. Rob Randava is Senior Counsel at the Leadership Conference on Civil and Human Rights, and Rob specializes in a variety of policy issues with civil rights implications, including immigration, housing and lending, national security, and voting. Eric Rodriguez is the Vice President for the Office of Research, Advocacy, and Legislation at the National Council of La Raza. He's also a board member of the Center for Financial Services Innovation and the NCLR Action Fund, and a member of the National Academy of Social Insurance. Prior to NCLR, Eric was a Congressional Hispanic Caucus Fellow and served in Representative Nydia Velasquez's office. And lastly, David Haber is the CEO and co-founder of Bond Street, a New York-based small business lending startup. He was most recently an investor at Spark Capital, where he focused on marketplace and financial services investments. Prior to Spark, David co-founded Locus Analytics, a startup asset management business. Before they take the stage, two other notes that may be of interest. First, if you are on Twitter, you can follow along today at CapEconomy and use the hashtag CapConsumers. And second, while our panelists can certainly speak for themselves, this morning we released a list of 5 trends to watch in consumer finance. That's up on our website, and we also have copies available to take before you leave. Thanks again. So I think we should start by seeing what people are hearing on the ground. So Helene, let's start with you. You are answering readers' questions fairly frequently in your columns. What are you hearing from the American public about the financial situations that they're in?
Where to start? It's still very difficult post-2008. It might not be as bad as it was in 2008. In fact, it's not. But my inbox fills up regularly. Just so everybody knows, I now have a column once every 2 weeks called Ask the Bills, where people actually can write me and ask their questions. And it literally encompasses everything from how can I get a credit card so I can use my miles to go to Mallorca, to I have student loan debt and I'm getting married and I want to buy a house and I'm afraid I'm not going to be able to have children. And oh yeah, and I have a $10,000 health insurance bill because I had an emergency last year and found out the doctor was out of network after the fact and nobody would help me. So I think there's still a huge need for help out there. I think things have improved. The CFPB has made a huge difference, but it certainly hasn't. I think it has addressed issues at the margins to an extent. It's sort of helped with small things, but it really hasn't taken over the bigger picture because that's outside of its mandate. It can't.
Rob, I know you've done some focus groups on opportunity and mobility in communities of color. The last panel spoke quite a bit about the racial wealth gap. What have you been seeing?
So about a little bit over a year ago, we undertook some research with the firm Brilliant Corners there are much bigger issues, involving the racial wealth gap and poverty and, lending practices that mere messaging and public opinion research would not fix. But we wanted to try to look at what can we do incrementally to improve the way that everyone from financial institutions to counselors to churches, are communicating with communities, with underserved communities about personal finance. A lot of what we found was, focus groups and polling of African American, Latino American, and Asian American communities. And a lot of what we found was sobering and not very surprising. A little over 50% of respondents put little to nothing into savings every month, and it was usually just the mere cost of living, which is, like I said, one of these bigger structural issues that has to be addressed, but that makes that impossible for a lot of people. There's a really strong reluctance for people to talk about their financial situations with friends or anyone in the community. And overall, there was a lot of pessimism about their own situations. Now, the one opening we did find was when we talked about future generations, and so we really tried to test that and looked into what kinds of messaging could be used to relate to children about finance, about understanding the difference between wants and needs, and having discipline, and so on. We found overall the best way to talk to people was more immediate and short-term in nature. Having a rainy day fund, less stress and peace of mind, and not having to ask other people for money, and the stigma that comes with that. And, comparing, we found that was a lot more influential than longer-term goals like homeownership or retirement, which can come off as tone deaf to people who are just struggling to even put a little bit of money into savings every couple of weeks. And at least that opens the door to progress in those other areas. So the most effective messaging we found was on just having a responsibility to teach children, and we did a presentation on that. That's available on our website as well.
Eric, piggybacking on that, what have you been seeing in the Latino community and the financial marketplace?
Yeah, I think, well, first, of course, Michael Barr said everything I was going to say, more intelligently than I'm going to say it. One thing that's true is we, at NCLR, we represent a network of community-based organizations that do a lot of financial counseling and homeownership counseling. So we get a lot of stories from the local level in addition to the work that we do at the policy level. And I'd say a couple of broad things. When I fell off the turnip truck here in Washington, D.C. 22 years ago to work on Capitol Hill, a lot of what we were talking about with respect to inequality was about poverty. It was very, very focused on poverty. And there were basically two essential ways of addressing that. One was to look at safety net systems, and the other was to look at workforce development and skill building systems. And over that time, as the economy became more sophisticated, as more households became more sophisticated with respect to their finances, as markets became more complex, things started to change, but racial disparities did not, right? And so even though we saw more products, more tools that were out there, and this was reflected earlier about the subprime crisis, we put out a paper on disproportionate subprime lending and the effect it was happening on Latinos in 2003, while people were talking about all kinds of other, and the reason why, in part, was because if you went to any Latino neighborhood across the country and you opened up the local newspaper, the Spanish language newspaper, all you would see is subprime lending advertisements to that entire community. Now, if you opened up the English language paper, it was prime banks that were doing advertising. So there were lots of different ways that the community was being targeted that were much more subtle than just overt racist stereotyping. Things were changing in those markets, I think, quite dramatically before our eyes. And that's why one can argue that over the last 20 years, we've had colorblind policies around asset building and financial services and wealth as a policy system, and it still produces tons of disparities. You heard Jim say 15 to 1 for African Americans, 12 to 1 for Latinos. How are we supposed to address those disparities if we don't call them out and put in place specific policies that remedy that? And the issue is that it is more systemic, as people have talked about. When automated underwriting came onto the mortgage market, that was supposed to be a way to avoid discrimination through manual underwriting. People sitting down with Latinos who don't speak English and saying, well, I can get away with this, and they would kind of check that box. So automated underwriting was supposed to change that, but the problem is if you're young or you're an immigrant, you don't have a long credit history. So the reality is that you got disproportionate loans on the other side of that, high cost loans. So we know we have to address this through more systemic issues. We know that we have to call it what it is. If we care about race-ethnic disparities, we have to say, we have to address it more directly. So what we see now as we look ahead is, it's not about fairness anymore, right? We used to say, look, it's just be fair with our community. Give them an opportunity. Right now, because of demographics, it's in the country's self-interest to try to find more ways to bring more young Latinos into the financial mainstream system. And they're having problems, right? So when we look on the horizon, a lot of people are talking about Latino millennials, they're voting, they're getting out there, but here are the issues that they're facing, right? They're having trouble leaving college and finding jobs, right? They're saddled with lots of student loan debt, right? That affects their financial decisions and their ability to buy homes. And home equity is so crucial to long-term wealth accumulation. So these are all the bucket of issues that we look at on the horizon if we're going to address those issues more specifically.
So I'm going to get back to specific policy areas in a minute, but I want to turn to Elaine since you mentioned all of the information and advertising out there in the market. Because I know, Helene, you've looked at so many of the books that are out there and analyzed folks on TV, and you've written a couple of books. How do you respond to the sort of deluge of financial information that people are receiving?
Well, I think this is where regulation has to come back in, and I think we're often dancing around this point. Joe turned to me because I am notorious for pouring cold water on the concept of financial literacy, which is one of those things that really sounds wonderful, and I always feel like when I start talking about it, I'm bad-mouthing apple pie and Thanksgiving. So let me just start. When I started Pound Foolish, when I wrote the book proposal, I had this really optimistic chapter at the end called About Financial Literacy. And I was convinced that this would actually be a solve for some of the issues. Now, as part of the proposal at the beginning, I had written something about a line along the lines of, there were all this financial information that exploded post-1980, and yet at the same time, we've gotten ourselves into such a mess. How could this have happened? Well, of course, when I started to look into it, it totally made sense. This explosion of financial regulation, of information, coincided with the deregulation of everything else in our financial lives. And there's no, to start with, there's no board somewhere that says this is financial literacy and this isn't, right? There's a bunch of different outfits, but anything can pass itself off as financial literacy, so all sorts of stuff do. But there's bigger issues than that. The academics who have studied it, for the most part, have come to the conclusion that people who take classes in financial literacy or read materials on financial literacy don't really recall much of anything after about a year and a half, which actually makes sense if you think about your own high school education and what you can recall now. As I always like to tell people, tell me about the 7 Years' War, the French and Indian War, and how all that led to the American Revolution. And people give me these blank looks, and I say, well, you had to learn that in high school. It caused the taxation issue. So, but the third issue is that it's not really possible to educate people a way around this stuff. Circumstances change, products change, people are responding in real time. And there's no real way to give somebody a class in something and then have them recall it 10 years later. There's no way to prepare them for a world in which things will change. Health insurance has changed dramatically in the past decade. Mortgages have changed dramatically. You can't prepare people for student loans that they don't know that they might or might not need. And that's why I've really become convinced that a lot of this is simply regulatory issues in terms of potentially regulating interest rates, regulating how people are informed about things. And I guess the last thing I'll say is it's really easy to convince yourself you need a financial service, right? Everybody thinks their life is going to go well, right? You're going to get this payday loan, and you're going to pay it back in 2 weeks, and everything's going to work out great. Or I'm going to attend this college, and I'm going to borrow $30,000, which is the average amount that was borrowed by someone who graduated last year, and I'm going to be able to pay it back no problem. People are optimistic. They're especially optimistic when they're 18 or 19, but they stay optimistic. Americans are pretty optimistic. So it's very hard to educate them, like, well, actually, no, you might not be able to pay that back.
So Lisa, AFR was deeply involved in the passage of Dodd-Frank, the creation of the CFPB. It's been more than 5 years now. How's the CFPB doing?
So I think that our experience thus far, watching the Bureau's work, has just sort of demonstrated and continues to demonstrate what a good idea it was, and how important it is to have an agency with the sole and serious mission of actually protecting the public interest with regard to consumer financial products. I mean, our lived experience of the crisis and of the explosion of abusive predatory lending in the lead up to the crisis made the case pretty compellingly about how much damage abusive financial products can do, both to individual families, to communities, to our broader economy. My colleagues have, on the earlier panel and this one, have made the case, I think, about how much we need regulation of these markets. We don't need, it's not that the markets will work if we don't get in their way with regulation. Financial markets are structured by regulation, and we need rules to make sure that products are fair and safe. There's an incredible information asymmetry in many of these transactions, and there's no way, if you leave it up to people to take care of themselves and leave it up to firms to get away with as much as they can get away with, and that is their job, you will end up with a disaster. So I think we see again and again how important it is that the Bureau's there, and that it's doing a really, it's off to an excellent start. It's actually only 4 years old, not 5 years old, because they needed a year to get put up. But I think they've proceeded thoughtfully, driven by data, with a clear focus on their public interest mission and the need to stand up for consumers. They've returned more than $11 billion in fines from enforcement actions, and they've gone after both big actors who really are, bad practices that dominate the market, like add-on products in the credit card industry, and small, really bad actors who are engaged in specific abuses, both of which I think are part of a comprehensive enforcement program. They have completed a bunch of important rulemakings, and they have a huge menu of important rulemakings to come, which will have, I think, a much bigger impact on much bigger pieces of the market, because all this takes time. They have built in a bunch of things to make them public-facing and accountable to the public and responsive, like their complaint system, which is a public system, now including narratives, like their practice of doing essentially monthly meetings somewhere outside of Washington to talk about a policy or report, like the practice of reporting on supervision, which is something that we often recommend to other regulators as well, to give the public more of an insight into what's happening there. So I think, they've done an excellent job. There's a lot more work to do, and I think it's been particularly important and useful that they've been under immense attack from the financial services industry since the day they started operation and before, and I think they've had the right response to that attack, which is largely not to be afraid, but to actually take the action they were put in place to take, which is what then allows the rest of us to defend their work and make the case for it, and exposes what the fight is about. It's about whether they actually are willing to stand up to people. So I'll stop there.
So one of the regulatory fights that they're likely to engage in this year is arbitration. Why is that so important? I mean, it sounds like something that's just really arcane and very fine print and that people aren't typically thinking about.
Yes, it does. It does sound arcane, but it really actually is a pretty fundamental question of whether we have the rule of law, whether big corporations, in this case financial services companies, have to follow the rules, or whether they can break them repeatedly and get away with it because they have slipped some, usually not seen words into a contract that says, by the way, you can't take us to court, and you can't band together with other consumers to take to court. It really, is, as long as forced arbitration contracts are standard, forced arbitration clauses are sort of standard practice in consumer finance contracts, which by and large they are. Kind of the rest of our laws are only partially worth the paper that they're written on. We sort of only have the agencies for enforcement. And so this is a profoundly important issue, and one that, as people probably recall, Dodd-Frank told the Consumer Bureau to study forced arbitration to determine what its impact was on consumers and on the public, and then to take action to ban or limit the practice if they found that it was harmful. They conducted extensive research, put together an extremely long and carefully written study. They found harm, and they have now, as you said, started a rulemaking process to put in place limits that we think is going to be there's going to be huge opposition to this, but is an incredibly important rule. Just like quickly, like three little examples to give a sense of the reach and impact of arbitration clauses now and what it is that the CFPB is changing. There was a remarkable case recently where in California, a case was brought because Wells Fargo was signing people up for additional credit cards without their knowledge. So if you had one, or additional account services without their knowledge. And there was a case was brought saying, all these people were charged money for things that they never consented to buy. And the judge concluded that the case couldn't proceed because there was an arbitration clause on the products or services that the customers had agreed to. And there would have been an arbitration clause in those other contracts had they agreed to them, and so that was enough to bar the action from going forward. The case of auto lending discrimination, which has been an incredibly hard-fought piece of work for the Bureau, some years ago, there were a bunch of private class action lawsuits brought because people were borrowers of color were being charged higher prices in the auto lending market. People successfully brought these cases. They did discovery. They got the data that proved that there was discrimination. And they were able both to get money back for people and to win agreements that changed those practices and limited the damage for a while. But they were time limited, and they expired. And now there could not be private litigation over those matters because there's arbitration clauses. I'll stop on those two so I don't go on forever.
So I know there are a few other pieces on the CFPB's agenda this year. One of them is payday lending. Rob, Eric, any thoughts on how to make that really effective?
How to make it really effective? You got to implement it, and you got to put it out there. It's a really important issue. There's so many areas where there are exploding products that many Latinos and communities get offered. The Bureau's done a great job, I think, at responding. There's also a remittance rulemaking, which was very important to our community, and really the first time that we had seen a major rulemaking with respect to immigrant households specifically, and that was very great to see. But this is a really important area. I think there's no question that we have workers in communities that need short-term credit and loans. It's a tremendous demand. There's a right way to do it, and there's a wrong way to do it. And I think the Bureau putting down rules of the road for folks is going to be really important. But as others have said, the context of this rule is very contentious. And we know that once it's issued, we're going to have a big fight in keeping it certainly on the books and continuing to implement it in a way that I think helps the target community that we care about.
Yeah, I'd agree with that. I'm overall, subject to this rule actually, coming out sometime, in the reasonable future. I'm somewhat optimistic about it having a real impact. And also subject to what happens in November. And no matter what, Congress is going to continue to try to micromanage everything the CFPB does. And where it's a place where the industry just has the upper hand, where where money talks more than what consumers are, what was really helping consumers. At the same time, I think there are parts of the industry that see the writing on the wall. There are efforts to try to come up with products that may not be ideal, but are certainly better. One of the organizations that Eric works with, CFSI, is a big forum for promoting promoting more advanced technology and how it can be used to help consumers. So so that's it.
On that point, Rob, I know we also talked a little bit about discrimination in lending. Last year we saw a landmark Supreme Court decision on disparate impact, and there's lots of interest in combating discrimination. Where are we headed on fair lending?
So the inclusive communities ruling was a pretty pleasant surprise to some of us who were really worried about whether discrimination, whether HUD and other agencies could go after instances of discrimination where there was not stated openly discriminatory policy, but where it had a discriminatory impact. So it came as a big relief to us. Where we're heading next is the big development that came that same month is HUD's affirmatively furthering fair housing rule, which says that if you're getting community development block grants or other federal funding as a city or other level of government, you have a responsibility to work plans work in plans that account for affordable housing and more diversity, and that includes eliminating the kinds of zoning requirements that exist in a lot of places that prevent affordable housing. So that's one area. Seeing what happens with credit reporting, with credit scoring is another. There's companies like VantageScore, and FICO is also moving forward with a newer model that FICO 9 that as they talked about in the earlier panel addresses medical debts and the damage that does, and which to try to get a better sense of whether borrowers are really creditworthy moving forward. And then it's clear that the pendulum has swung the other way in the wake of the crisis, and it still has not swung back. But there needs to be some continued pressure on financial institutions to do that. American Banker had a good article yesterday about Mike Calhoun's partner organization, Self Help, and how they've reached how they have an arrangement with Bank of America where Bank of America will originate loans with a 3% down payment, and Self Help will take over these loans and back them, and just to show that, look, this can be done, this can be made to work. So, it would be great to see more work like that happen.
Absolutely. Eric, any thoughts on how to make sustainable home ownership happen? I mean, we think about Latinos are projected to be half of all new home buyers between now and 2020. We've talked about the demographic changes. How does the rubber meet the road here?
Well, those are some of the ways, right? And I think Michael had observed this as well with his initial 5 points, which is if there's one area we haven't done enough in, it's innovation. I mean, we understand that we have to make sure that we have a very safe financial market, but at the same time, if we are going to be able to serve all the credit needs of the communities that we care about, we need innovative products to be on the marketplace. We haven't really talked about technology, but technology can be used for good, can be used for bad. In the case of mortgages, and we need more of these kinds of things. I'm pointing to Calhoun and Self-Help and the work that they're doing with Bank of America, but there are others that are out there, and I think the more that either the Bureau or others can do to push companies and others to innovate, to try new things that bring more safer products or a product mix to communities that are growing, that are out there. It's not just going to be the number, more than half of all new home buyers by 2020 will be Latino entering markets, but it's also across the board in financial markets, how those numbers are going to be changing. And that's why it's less about fairness. If you don't like the fairness argument, forget about it. Let's talk about how we're going to make our country stronger, knowing that more and more states are becoming majority minority, and that we've got to find ways to for financial markets to work for them if they're going to equally invest and build community and the economy and the overall economy, right?
Absolutely. You mentioned technology. David, I know you've been patiently waiting. What's your company looking to do? What gap are you trying to fill?
Sure. Yeah, it's interesting to hear sort of the structural gaps that exist in the consumer market because they play out very similarly within the small business space. So Jim on the last panel described sort of this massive chasm between the prime products and predatory lending. that reality exists for small businesses as well. Banks are rejecting 70, 80% of applicants. And as we were thinking about starting a business, the alternatives started at, credit cards, factoring, merchant cash advances. And a lot of the early online lenders were playing in that space, offering smaller dollar loans at, 40, 50, 60% interest over very short durations. Instead, and by way of background, I'd spent a few years working as a venture capitalist, spending most of my time talking to technology companies, but would often run across physical products businesses or services companies who were also looking for financing. They didn't necessarily fit within our mandate or made sense for venture capital yet, but we're doing real revenue, we're profitable, we're growing, and either struggling to raise bank financing or could get access but kept telling us how painful and antiquated the process was. And so we built a company to essentially try to address that gap. It didn't make sense to me that folks who didn't check every box at the bank were forced to go pay 40, 50, 60% interest rates. So we've tried always, both from a philosophical perspective, to not charge what we would consider usurious rates, but also from a strategic one, to play as close to the banks as possible and to fill a gap and ultimately provide a softer landing if there is a decline. I think there's an interesting sort of history here that in many ways has left small businesses behind, right? It used to be that community banks were the lenders of record to small business. And this isn't a trend that's just played out since the financial crisis. This is one that's been happening for 20, 30 years. There's been massive consolidation within the financial services space. And as the biggest banks have started buying regional and community banks, if you look at the concentration of assets over that 30-year period, while commercial lending has increased, small business lending has dropped off pretty precipitously. I think what's also been interesting is that in some ways, regulation, while it's taken out systemic risk in the markets, has also taken away capital from small businesses in some ways. They're having to hold more cash on your balance sheet for smaller, riskier loans makes the unit economics of $100 million loans to billion-dollar companies much more favorable. And that, in the context of a financial system, traditional financial system that has never really invested in technology, at least at the retail space, ultimately makes small business lending pretty unprofitable. And so that's kind of where our lens and kind of the white space that we were trying to fill is to leverage technology to not only make access to capital available to small businesses, but to create a much better customer experience. Today, you can't apply for a loan online at any bank in the country. Right? You have to walk into a physical branch, print out your physical financials, hand it over to a loan officer. They're faxing it or mailing it to Texas typically. Somebody's rekeying in the data by hand, and then 4 to 8 weeks later, the customer gets a decision, and 80% of the time it's a no. It seemed like a very painful process, and one that should be solved through technology. And so, what I was seeing, and my partner Peyton was seeing, in our sort of prior careers was this whole financial software ecosystem opening up. And a lot of the data that we thought we might actually need to underwrite these small businesses was suddenly becoming accessible via API. So whether it was companies like Intuit that had 5 million QuickBooks users, or Xero, or Stripe, or Harvest, or Braintree, the list goes on, we recognize that we can now get access to this data through software integrations, and not only make faster decisions, but make smarter decisions. It was really interesting, and I only really came to appreciate it once we started the business. Was the first hire we made was actually the former head of risk at Citibank for small business lending. And somehow we convinced him after 30 years working in banks to come work with us, initially in my apartment building. But at most banks, loans often under $500,000 and most often under $250,000 to small businesses are made entirely off credit score. Right? It's consumer and business credit score. They'll have somebody sign a 4506T tax authorization form. They'll never actually pull the tax filings. And to me, that was a very two-dimensional view. They weren't actually looking into the financial health of the underlying business. And that's actually the opportunity, in my opinion, that technology affords us, is to get instant access to somebody's QuickBooks financials and to see sort of their historical P&L, balance sheet, income statement, connect directly into the bureaus, connect into the IRS, connect into deposit accounts, and in a few minutes get a very holistic view into the financial health of a business. And he likes to say, our team is now getting access to more data on a $50,000 loan than on a $1 million credit he used to have at a bank.
Well, clearly there is a lot more data that's available for you to use. It's something that we see in the small business marketplace. We see it in other forms of lending as well. I'm just going to open it up for the group if anyone has any thoughts on big data and its usage.
Or do you want me to?
You go ahead.
Oh, you.
Okay. Well, I mean, it's something that we are still trying to wrap our brain around. I mean, I think it's, especially as I'm getting older, it's getting harder and harder to understand, a lot of the technology that goes into it. But we see it as a force for good and a force for potential harm, and just trying to steer it in the right direction. My friend Bill Bartman here runs Financial Samaritan, which can use technology to negotiate with creditors and then connect consumers to better financial products. At the same time, there are other players in the industry who can use your web surfing data to try to target you for payday loans. So we're just trying to continue understanding it and then trying to steer it. At the same time, try to steer it in the most positive direction.
Yeah, I would just add really quickly is that the civil rights community has come together to really think about technology and its uses and applications, and there's a set of principles that the organizations through Rob, I'm boosting Rob here, has really put out there, because I think there's broader recognition of the trouble that we potentially see, but also the potential good to advance civil rights issues. So it's something we're looking very, very closely at.
So if I could keep boosting the Leadership Conference's civil rights principles for big data, which I do think are incredibly important, because there is the potential for data to be and technology to be a force for enormous good and to do lots of damage. I think I'll repeat the 3 principles that I think are the most relevant here. Ensuring fairness in automated decisions, enhancing individual control of their own personal information, and protecting people from inaccurate data. I think among the things I worry about very much are kind of discrimination in pricing and in availability and in kinds of products happening in ever harder to see and monitor ways. And I think we will be especially dependent on our regulators, on the CFPB, for example, in this space, and on other regulators in other spaces, to make sure that there are protections against data being used in ways that does an even worse job than, unfortunately, there's been plenty of big data already in credit decisions. And some of it does damage to people because it's inaccurate or because it's too hard to correct. And some of it does damage because it is used wrong. That is, it's used as if it measures responsibility when it actually measures wealth. And so it really can be an incredibly powerful driver of charging lower wealth people more for service. And I think it gets harder and harder for members of the public and for advocates to have a window into that if we don't have regulators insisting on transparency at every level. And I don't mean just like transparency so your data is being used. I mean, what is going on and what is the impact and what are we seeing?
Yeah, just to be more specific on that. Look, if you Google cash, you're going to get payday advertisements almost immediately, right? So there's an element of that certainly is technology. So it's an important example or illustration of concerns that are out there.
I would also just point out one other thing, in that there's a real privacy concern here. I think we're talking about, well, will it be used for good or for ill? I can tell you there'll be 10 great players and 1 bad one. And unless you really start trying to regulate a way around using this data in a way that is not discriminatory, that protects it, that ensures some people some right to privacy, it will eventually be used for ill by somebody. I mean, that's just common sense. And I think we really need to take into account that fact.
Can I throw out one thought in reaction to your comments on small business lending, which is I couldn't agree more about the incredible need for sort of good products for truly small businesses, especially, and some of our membership includes small businesses and small business organizations. It does seem to me there's a lot of, as you I'm sure know extremely well, there's a lot of kind of blending between personal lending and small business lending at the very small side. And I think it becomes more and more obvious that there's really a need for some of the kinds of consumer protections that we have now with the Bureau, and we'll increasingly have with the Bureau in the consumer finance world for small business lending as well as a need for some more of the detailed information about what's happening and what isn't.
Yeah, I couldn't agree more. I think if you look at the spectrum of players in the market, there are a lot of folks who are not transparent about what people are signing up for. And you can debate the need or the efficacy of shorter-term credit or even more expensive credit and how it solves financial gaps that people have. But I think there's a moral obligation for people to understand what they're signing up for, period. And so when merchant cash advance companies are talking about an interest rate, but it's actually on a monthly basis and amortized across the year is 100% interest, like people should understand that, and whether it's a factor rate, not an APR. Most of the entrepreneurs that we talk to every single day are incredibly passionate about their product or their service or their craft, but they're for the most part not finance people. And I've always believed and our broader mission at Bond Street is to be more than just a lender. It's to be sort of what I describe as every business's financial advocate. And I actually think that technology affords us the opportunity to offer more value beyond just the transaction. Ultimately, we are solving a real problem in the market by giving people access to capital, but capital is also a commodity, and I think if we can offer people insights into their business and help them ultimately grow their business more successfully, then that's value beyond just a very cold sort of transaction. So I sort of respect, I respect the
Sort of.
the perspective of privacy, but I also see a tremendous opportunity to create a lot of good in the market where if we have a coffee shop who's applied, and we've worked with 300 other coffee shops, we have a tremendous amount of data on what the average healthy coffee shop should look like. Even before somebody's borrowed from us, how do we resurface some of those insights back to the entrepreneur to help them identify issues in their business that they can work to resolve, to increase their credit profile, to make capital not only more available but also cheaper, and even after they become a customer, how do we we maintain connections into their accounts? How do we surface both opportunities for them, but also potential downsides? And I think in my mind, and that's ultimately it sits at the core of what we're building from a technology perspective. It's a very sort of self-perpetuating thing where the more information you can provide an entrepreneur to be successful in their business, the lower your default rates, the more access to capital you can get. And I think that's kind of, if I had to sort of predict where the world is going from sort of the traditional financial institutions, which I'd argue have been historically very sort of transactional, it's about building sort of a longer relationship with a customer through technology.
So I'm going to, go ahead.
Yeah, I was just going to say, the one thing with technology is I think we're all still a bit in the proselytizer stage right now, where it's all very wonderful. But I think it helps to keep in mind that technology exists in the world we live in. It doesn't exist in some perfect world out there. And I think we all need to understand that, as we've all said, it can be used for good or for ill. And ultimately, if we want it to help people the best, we need to work at the underlying situation. We can't assume technology is going to fix the underlying situation. It simply probably can make it better for some people on the margins, and it can make it worse for some people on the margins. But in and of itself, it probably can't change what is the economy of the United States in 2016.
Lisa? Looked like you were
No, I was
ready to respond.
Okay.
So before I open it up to our audience, who has been very patient today, I do want to give everyone sort of the last word on either something that hasn't come up today or something that you think really should be on the radar of regulators and policymakers over the next few years. So, Eric?
Yeah, sure. There's a number of things we didn't touch on that are enormously important as we think about narrowing wealth gaps and creating more opportunity. We didn't talk about pension issues and retirement savings, but that's a huge bucket of potential opportunity, but an area that we have to spend some time and focus on. There's no question that a lot of potential opportunity but dangers around tax reform. So as people think about what are the policies or measures or things that we need to put in place to incentivize or create more wealth building opportunity to make sure it's fair and equitable, will be in some kind of tax reform conversation and discussion as well. No question, we need housing finance reform at some point. We're going to come around to that. And that's going to be enormously important for communities of color and everyone, really, as we talk about how we got to reshape markets of the future. I will say one thing that is really on my mind quite a bit these days is, when we used to think about wealth inequality, we thought mostly not about the product you can get today that's ultimately going to make you wealthy tomorrow. I think what it really was is how do we have more mobility over generations? And there were a couple of ways to do that. One was to think about family wealth transfers, which are enormously important, both in explaining the wealth disparities that we have, but also in thinking ahead about the changes that need to be made. And that's a tax issue as well. But the other great equalizer was supposed to be the educational system in the country. And those are two things that concern us quite a bit, because we're getting to a point where a quarter of K-12 kids are Latino now. And what we're seeing also is that we've got a system that isn't producing necessarily college-ready kids right now. So if you look at the K-12 system, and Rob and I and some other organizations have been focused a lot on education reforms, California is a perfect example where we've got 20% of valedictorians graduating from high school that are Latino are in remedial education when they enter college. That's stunning, right? That should be shocking to most folks. So something is happening in our school system where graduation rates are actually going up, which is positive, but we've got kids that are not college ready right now who need a lot of assistance. At the same time, college completion is a problem. So we've got a lot of kids, minority kids that are going through and going to college. They're taking out these huge loans. They're not finishing school on time at the same rate of their peers. So when we think about the ways in which we want to seriously and significantly address race, ethnic wealth gaps, we're thinking about it over generations, and the means at which we used to see that kind of progress, we're seeing some troubling signs right now. So those are things that are certainly on our minds.
Just tacking on to what Eric said about housing finance reform, in one respect, it's a little bit more urgent. Mel Watt, the regulator for Fannie Mae and Freddie Mac, pointed out last week something that we've been trying to say for a while, is that Fannie and Freddie are in a pretty precarious position. They have a shrinking capital buffer by design, by the arrangement they have with Treasury, and there's a real risk that in one of the coming quarters they could have to go back to Treasury for more money, which, in terms of the backlash that there could be for the mission role they play, the affordable housing goals, the trust fund, the housing trust fund, or the coming work that they'll do under the duty to serve rule. Those could be. I mean, Fannie and Freddie. Those kinds of mission elements that they've had before have been scapegoated for the financial crisis, and they could come under attack again if there's a draw. So we're trying to get some attention to that.
So of the many, many things one could add on, let me take 2.5 of them. One is, we talked a little bit, but probably not enough to reflect its incredible importance about student debt and the $1.3 trillion of debt owed by some 70 million Americans, which is just a huge burden, and there needs to be much more done, and it is encouraging that there's so much more conversation about both once again, making higher education free for many people in many contexts, and doing something about the debt burden of existing students. I want to, in particular, though, urge that there's an incredibly urgent need to do more about the abuses in the for-profit school system that has about 1.4 million students in it, and Mike raised this as well, but there are both hundreds of thousands of students who were in schools that have been closed because they broke the law, and it has been shown that they broke the law, and yet those students are still burdened with enormous amounts of debt, and the Department of Education is in a position to forgive that debt and is not acting speedily or effectively to do so. It's an incredibly important missing piece of action. And then there's much more that needs to be done to make sure that the next round of students is not entrapped by debt for an education they don't get. People who are hoping to learn and borrowing to learn, and not in fact coming out with a usable education. And the second thing I'd say is I think many of us talked about the wealth gap, about growing inequality, about the racial wealth gap, and about the many ways in which abusive financial products and wrong-headed policies make the poor pay more, and not just a little bit more here or there, but actually trap people in an increased cycle of debt. I do feel like there's some increased recognition of that fact in our communities, but I also feel like despite that, again and again, policy decisions about housing and about consumer credit and more are made in incredibly narrow contexts in which because something looks like it costs more if you only look at an individual or if you only look at one fund, or looks like it makes less, the fact of its broader impact on communities or on neighborhoods or on long-term wealth is ignored, and we end up with policies that, despite a recognition of these problems, with policies that actually move in the wrong direction rather than the right one. So I think a laser-like focus on actually attacking those problems is incredibly important.
I mean, hopefully, sort of the lens that regulators use is, in theory, to make access to capital more available, but also reduce the cost. And I think there's a number of ways that they can do so. I mean, one, and this is to your point, I think creating standardization in the market in terms of how people report the true cost of financial products is really important in the small business space. And there's some debate now whether that's within the CFPB's mandate. I think it'd be great if they did that. I have no issue with that at all. I think that potentially broadening the mandate of the SBA, which today only supports bank-chartered lending, there is a new world emerging of alternative lenders and who are providing real access to capital to consumers and small businesses. Are there ways to kind of expand, their oversight? Then there's also some very tactical ones, right? I think there's been a lot of interesting progress made at the White House with DJ Patel, who's the chief data scientist for the US, in making access to data more available. I think there's a lot more that can be done. There isn't a tremendous amount of great data available on historical small business performance, but to the extent that there is information, make it available so that people can use that to build better underwriting models. I think the IRS. It's funny that I never thought I'd be saying like the IRS should be building technology, but if you think about our process, the slowest part in our process is getting access to somebody's tax filings. It takes anywhere from 48 hours to several days. Building an API for the IRS to get access to real-time tax information could make access to capital much more available and much simpler for consumers and small businesses. So those are actually the last sort of piece, which is I think cumbersome for a lot of alternative lenders to sort of triangulate around, is there's a quilt of state usury law that consumer lenders and small businesses need to navigate. There's a lot of debate and potential new legislation around how consumer lenders avoid state usury law. I think creating some standardization even across potentially at the federal level so that lenders can more clearly navigate those waters would be super helpful.
I will try not to go on too long. I would just want to follow up on the student loan thing for a moment first. We have the most indebted generation right now. This is having an enormous impact on all of us in ways we think of it as an individual problem. In fact, it is contributing to housing problems, auto problems, housing formation. We have evidence that women, especially with student loans, do not marry at the same rates that their unencumbered peers do. And this has to be really begun to be talked about as we're all in this. So I would say that as the first issue. Second, I would like to, something that has not really come up is medical debt. which seems to be continuing to grow at absurd rates. The ACA has helped individuals, no question. It has also not solved an awful lot of issues. And I'm particularly thinking of the overall cost of our medical spending has remained fairly stagnant for the past couple of years. This appears to have been accomplished by a massive cost shifting. According to Aon Hewitt, between 2010 and last year, individual spending, if you had a workplace plan, went up by over 50% in those 5 years. This is a huge issue. There's now issues cropping up with a huge number of markets where it is almost impossible, if you're not working for an employer, to get anything but a basic HMO at a really high rate. It is becoming increasingly unaffordable for many people. I know they're filling up my inbox. So it has helped, but there needs to be a lot more work done. The third thing, to take on your point, usury is probably going to become a bigger issue. I know Bernie Sanders very briefly addressed it about a month ago. No one seems to be following up on it very much. It needs to be talked about more, especially with the rise of alternative lending. Again, some great players, some not so great players. People are hopeful, they want the money, they don't ask that many questions, and they often get surprised. And I think if you're going to talk about overall all-encompassing legislation, that really needs to be a part of it.
Open it up to the audience, and if you could just identify yourself, and we have Brendan roving with the microphones. In the second row.
Blake Donovan, Department of Treasury, Economic Policy. My question is about technology. I was at a recent event, actually at Brookings, that we talked about Bitcoin, which is a technology that we can move large and small sums of money across a peer-to-peer network system rather quickly and cheaply. So what role can Bitcoin, and to borrow the phrase, other disruptive financial technologies have on making capital more accessible to all communities in America?
Got nothing on Bitcoin.
No, I mean, I think a lot of the, it is really expensive to be poor in this country, especially with financial transactions. And a lot of the fees that get taxed at places like Western Union and others are for small dollar money transfers, where the fee itself can often represent 10 to 20% of the total dollar amount transferred. And so the promise of Bitcoin, or even the blockchain, is the idea that you can transfer money anywhere in the world, frictionless and without fees. And so I think ultimately you reduce the tax on poor people not only in the country but around the world who just want to have access to capital.
Maybe one thing I would add, not so much on Bitcoin, but I think somebody, I can't remember, one of the panelists mentioned postal banking, which we think is a great idea for making taking advantage of an existing infrastructure to make basic banking services more available. And money transfer, for which there is actually a place that always strikes me as bizarre. It's not technologically complicated, and yet it is strangely difficult to send money from one place in the United States to another place, much less to send it abroad. There actually are systems out there with decent capacity that the Postal Service doesn't participate in, and that other entities don't participate in, and that they could. So there are some, removing some barriers to taking advantage of existing infrastructure and capacity would be very helpful as well.
And in the back.
Tom Dowling, Center for American Progress War Room. So a lot of the solutions that have been provided so far have kind of fallen on this spectrum from, like was just previously brought up, the United States Postal Service providing those personalized financial tools, to at the other end, the private market, which would, fill that role. So most of you seem to fall sort of in the center, where you have a very protective financial institution apparatus that regulates the private system. So if you were trying to come up with solutions more on a macro level, where on that spectrum, excuse me, is the most effective way, excuse me again, to provide that solution?
both. I think both and it would be the place that I would start on an answer. I think we need more explicit recognition of how basic access to decent financial services products are. It's not just a toaster. A, it can be way more dangerous if bad things happen, and B, you can't choose to do without it in some ways. You need it to do everything else. And so I think that and the damage it does can be so great. That recognition ought to spur sort of more thinking about the full spectrum of responses. Interesting private sector products in the context of a robust system of rules and regulations, and more public solutions to pieces as well. I think that's part of the appeal of the postal banking idea, to have a public option for some of this stuff in the mix.
That's not how they'd market it, though.
No.
I would just say, look, we've been through an environment where regulators weren't paying very much attention to what was going on, and we see what happens when we exist in that market. I don't think we're going back to that anytime soon. So it just kind of feels like the future is more about putting, as they say, guardrails in place and seeing how you can shape markets in a way that serve more people equitably and give more opportunity to succeed. There's a lot of room in there, but we don't want to go back to an environment that we were living in before, which was chaotic, and people paid the price for that.
I'll just add, a healthier economy would make some of these issues less pressing. I always like to point out we had a 10% savings rate in the early 1980s. We didn't become collectively more stupid. What happened was the income gaps began to open up at the same time that the regulatory apparatus went away. And I think you always need to remember that.
All right. On that note, if you can join me in thanking our panel today. All right, thanks again.